Dividend investing strategy for beginners. How to choose the best stocks. It can be difficult to know just how to get into stocks if you have no prior experience with the stock market. Fortunately, dividend investing is not only a relatively straightforward method for getting your feet wet in the market, it can also be a very effective way to introduce passive income into your investment portfolio. In this episode, we'll explain what exactly a dividend is, why companies pay them to their shareholders, and how you can make the most of them to build a solid and diversified investment portfolio. What is a dividend? In its simplest form, a stock dividend is an amount of money, usually in the form of cash, which a company pays out at regular intervals to those investors who hold shares of its stock. When you buy shares in a dividend-paying company, you're effectively buying a very tiny fraction of ownership in that company, and as a partial owner, you're entitled to share in any profits. Many companies issue lump sum payments on a quarterly basis, or every 3 months, and when a business produces strong and stable earnings over the long term, its dividends not only remain consistent, but often benefit from regular increases as well. Why do companies pay out dividends in the first place? Not all companies offer stock shares that entitle the owners to regular dividend payouts, so it's obviously not mandatory for every business with public shares to do so. Stocks that pay dividends are meant to serve as a signal to potential investors that a company is financially strong and stable, and that it expects to remain so over the long term. Essentially, dividends are a real-life indicator of a company's financial health, and they indicate that the business is confident in its ability to perform well consistently enough to earn a regular profit. Many people like you who are looking to generate passive income through the stock market will choose dividend-paying stocks over other types for this very reason. So it's a great way for a mature and stable company to attract new investors and sell more shares. After all, it's partially through investor dollars that a business continues to fund its operations and growth activities. And there's the added benefit for a dividend-paying company that any increases it can make to its dividends will lead to a correlating increase in its stock price and to its overall value in the eyes of potential investors. Investing in stocks that pay the highest dividend is what is known as dividend investing. So what is dividend investing? Dividend investing is a strategy of buying stocks that pay dividends in order to receive a regular income from your investment. This income is in addition to any growth your portfolio experiences as the stock in it gains value. How dividend investing works. Dividend investing allows you to create a stream of income in addition to the growth in your portfolio's market value from asset appreciation. Experienced dividend investors like to invest significantly in stocks that pay large dividends in order to make money. Buying stocks that pay dividends can reward you over time as long as you make intelligent buying choices. If the company you own shares of has a dividend reinvestment plan, or DRIP, you can choose to have your dividends reinvested to buy additional shares rather than having them paid out as a profit. This is a useful strategy when your dividends are small, either because the company is growing or because you don't own much stock. Let's look at an example. Say you buy 100 shares of a company for $10 each, and each share pays a 30-cent annual dividend. You would have invested $1,000 and over the course of a year received $30 in dividend payments. That works out to a 3% yield. Not too shabby. What you choose to do with your dividends is up to you. You can reinvest them to buy more shares of the company, buy stock in a different company, save the cash, spend the money, use it to pay a bill, or buy a pizza to celebrate. Regardless of whether the company's stock price goes up or down, you would receive those dividend payments as long as the company continues to disperse them. The beauty of stocks that pay dividends is that part of your return includes predictable quarterly payments. Not every company offering dividend stocks can maintain a dividend payout in every economic environment, something that the COVID-19 pandemic has demonstrated. But a diversified portfolio of dividend stocks can get you reliably paid rain or shine. If you're still unsure how dividend investing works, make sure you hit that subscribe button and stay tuned for our future episode covering that topic in detail. So, how do you find the best dividend stocks to invest in? Step 1. Look for stocks that pay dividends. Dividend investing for the purpose of building a passive income stream is really only effective when you look for stocks that pay out regular dividends to shareholders. At the same time, however, companies that pay out too large a portion of their earnings as dividends run the risk of coming up short in terms of having the available resources to fund their future growth. and it's a company's continued growth that provides the basis for regular dividend increases. Ideally, you should look for those businesses that retain a minimum of 40% of their annual earnings to reinvest in their own development. And as an investor, this means seeking out those stocks with a dividend payout ratio of 60% or less. Step 2. Look for financially strong businesses. Companies that are mature, stable, and financially strong provide the best chance that an investor will continue to receive consistent dividends that offer good potential for increases. As such, you should only consider solid businesses that have a history of strong financial performance and that have demonstrated consistent growth in both their net income and their cash flow. In practical terms, this means looking for low-debt businesses with a debt-to-equity ratio of less than 50%. Since the more debt a company carries in relation to its assets, the more income it must put towards supporting that debt, and the higher the risk that this liability will begin to cut into its dividends should earnings drop off for any reason. Step 3. Consider a business's future prospects. Beyond just maintaining dividend payouts, companies selected for passive income investment purposes should ideally be striving to increase those payout amounts on a regular basis through earnings growth. This means you should look out for those businesses that have a selling advantage over their competitors, or which offer a product or service that will remain in high demand over the long term, or that demonstrate strong management performance. Any of these attributes can contribute to a company's successful future growth, and the details surrounding its management policies and expansion strategies can be found in every business's annual report. How to build a diversified portfolio. Dividend investing can provide a good source of passive income, but it's not necessarily the fastest way to grow your money over the long term. There are other investment vehicles that can help you to grow your profits at a faster rate, and you should consider investing in a variety of investment types in order to take advantage of their various benefits. Diversification within your portfolio remains one of the keys to investment success because it can help you to both dilute risk and to maximize returns. Rather than investing all of your money in dividend-paying stocks, you would do well to also include investments such as exchange-traded funds, ETFs, and value stocks in your portfolio. While income stocks will help you to create a good stream of passive income, ETFs can contribute to the long-term stability of your overall portfolio returns, and value stocks may help to increase those returns at a faster rate. Is dividend investing right for me? Dividend investing is by far one of the best ways to use the stock market to generate passive income and to increase cash flow in your investment portfolio. Remember that not every dividend-paying stock is useful for this purpose, and you must learn to identify the profitable ones in order to continue to build your wealth. Before you purchase any investment, you should take the time to become familiar with exactly how it works and its inherent risks and possible disadvantages. If you learn as much as you can about the dividend investing approach before you buy your first stock, you will greatly increase your chances of benefiting from regular, long-term passive income with as little risk as possible. That's it for this episode. Please give us your feedback in the comment section below. To watch more episodes on financial topics like this, hit that like and subscribe button. If you want to support us even more, buy us a coffee from the link in the description. Good luck, and see you in the next episode.